Hi, this is Randy Finney with the Right Side of the Chart, and today is Thursday, April 7th, 2022. It is 2:14 Eastern Time as I'm starting the video, and I'm going to cover in this video, we'll look at the equity markets and then just updates on the various asset classes I've been highlighting other than equities. That's gold and silver, treasury bonds, and it's pretty much it. I'll comment on some of the other trade ideas in the video, but we won't get too granular in this one. Just kind of brush on what's going on bigger picture. Speaking of bigger picture, as I go down, I always cover various time frames. I'm going to get down to the 60-minute charts that I've been highlighting lately, show you what's going on there. I got an update out this morning. Pardon my absence or silence. I was spent a good part of the day. Had to go down to the airport, get signed up for that TSA pre-check. I'm flying to Hawaii next month. My wife and I, I'm just got connecting legs. Anyways, you get that TSA pre-check. Let's just skip the lines, and that's a biggie. So I'm back at my desk now, and I'm caught up, and that's why I'm starting the video here. So let me just talk about big picture again. This is it. So if you're swing or trend trading, and that's what I'm talking about here. You want to look at the most significant development most recently was another back test of the 200-day moving average. That's this blue line here. Simple moving average. We broke it there, and once you break it, it brings ushers in selling. It's a big level, watched by not just me but many traders. Has been that way for years. For whatever reasons, it's all that matters is that's where sell programs and buy programs kick in. Got rejected there. It made another run at it, a couple more candles, big rejection, a big drop, and we ran up. And so what's interesting, or what I've mentioned many times, is the only other times in recent years. Remember, there's not. I can go back 20, 30 years. You've got to go back really far because we've been in a nearly well over 10 years, almost a 12-year bull market, really, since the NASDAQ bottom in late '08. Rest of the markets bottomed early 2009. So there's not a lot of instances where we traded below there, but those that stand out are when COVID hit, that 36% drop in the S&P 500. You took it out right there, and then you recovered it there, and the bull trend resumed. Back at the second biggest correction in recent years, or even last decade, was this drop in the fourth quarter 2018. You took it out right here. You back tested it there, got rejected down to there, and one more back test. So that's probably more comparable to what's going on today if you want to use similarities, because COVID kind of took the markets by surprise, and everything tended to move pretty fast, of course, with the economic shutdowns and all that. But this is a more natural progression of a correction or bear market, if you want to call it that. Again, semantics, in my opinion. I call it a correction. Drop, you come back, and you had a one-day regain, test it again. And so it's been about the same amount of time before that second test. So you had the first test and rejection, then the second one did the trick. And look, we may or may not be at that same point. History doesn't always repeat, but it often rhymes. Won't rhyme exactly each time, but that's what we're looking at. So there's your first rejection, first drop, and another comparable second rejection. So again, if you're swing or trend trading and you're keeping your eye on the prize that are much deeper targets in the coming weeks to months, then it's simple. You were able to reload some shorts back on the bounce back to the 200-day, and you'd have a stop somewhat above, or you can even have a wider stop, again, depending on where your targets are. You don't even see them here on the daily chart because I'm looking for a long term on these targets down here on the weekly chart, all the way down to about 235, which again, I've covered it many times. If that final target, or those, let's say the third or fourth hit, that's 34% drop and a 42% drop off the highs. And again, that's only going to take us back to our primary bull market trend line. Okay, so kind of a recap for those of you that have been on top of my analysis lately. Nothing new there. To go down to the 60-minute chart, I got one post out to you this morning before I left, and that was this. We had back here sell signal to come on the break of that trend line, or an objective short at the 370-ish level. Either way, about the same level, and it played out almost perfectly. Reversed a little shy of my first target there, bounced as expected, then went through, and even when we got here, I told you that we already had pretty much the reaction, therefore I wouldn't expect or try to game another reaction there, that we would probably go on down through there. That's what we did. Hit my next, that was additionally my final near-term target, but when I use the word near-term, that's just, coming days to weeks. Again, as I just started out the video, if you're longer term, then you don't worry about these little squiggles and zigs and zags, but that's what the squiggles were. Bounced back to where expected yesterday, that another back test of that 357.15 level almost perfectly. Look at that on that candle right there. And then boom, took out that 351.68. Now, yeah, that's why I'm doing the video. We did go back up through there, but we took it out. Price action so far, then very near term, really from right here, shortly before a sell signal at the top of that bearish rising wedge. That's what we're in. We're walking our way down, and only time will tell if we have a lot more. But that's where I'm leaning towards. And so while it, at times I'll take those active trades, I'll give you the setups on the 5-minute charts or even the 60-minute charts, game little bounces. I'm more apt to kind of sit tight, especially on swing and trend short positions. I wear different hats myself. I have longer term accounts and then an active trading account. And so that's where we're at. And here's the thing. We already had the back test and rejection off 357 and change. And so ideally you want to see it stay below there, but it's not the end of the world if we take it out. There's still a gap that has not been backfilled right there. We can certainly backfill that gap and still very much keep this downtrend intact. Again, downtrend, lower lows and lower highs and lower lows. So that's certainly very much possible. Where does it really start to muddle up the charts? To run back up there again. We've already had, when you look at the daily chart, we tested that 200-day 1, 2. We were just a hair below it there, so call that 3, 4, 5. That's a week of back testing it there, followed by an impulsive rejection. Sure, anything's possible. You could test it again and get rejected, but ideally, for the bearish case, I don't want to see that. Let me just say that. That's ideally. Because if you get up there again, you might punch through it. I talk about support and resistance. It works this way. If you have a stock or the market or whatever it is, and let's say this is a support level here, and you're tapping on it, sooner or later that level's likely to break. Not always. Sometimes you're in a trading range, but if it does, then it usually brings in a lot of sellers. Likewise, if you have the 200-day up here and you keep tapping on it, to make another run at that now is going to increase the odds that you're going to break it, because you already had the pretty impulsive rejection. And that's what, again, speaking to my positioning, not my bias, but both one and the same, but to the bearish case, you don't want to see another run up out there. Again, anything is possible, could get rejected, but the fact we already tested it for a week, now started to get rejected, it would be ideal not to see another test. At most, I'd want to see a back test of the gap. Another way for me to translate what I'm trying to say is if we backfill the gap, I've certainly have some dry powder to add. I might add my last and final short position there for a trend trade, longer term trade, but I wouldn't add above the gap, and I certainly wouldn't add if we take out the 200. 200 was not my line in the sand. There's not a hard line in the sand, but it becomes pretty darn hard if we take back that bottom of that multi-month trading range right there at about 378. And I can tell you right now, that's where I would be more concerned about reducing or covering short positions, scaling back out if that level's taken out versus adding any more short exposure. But we'll take it one day at a time. As of now, I don't think that's the most likely scenario. I think the most likely scenario is more downside. My convictions start to get a lot higher about those long-term targets getting hit if and when we get near another rundown, especially take out those recent lows. So there's quite a bit of work to be done, but there's my thoughts. Short, sticking with it for now. Been pretty clear on that. Started, getting back into some swing shorts here, and just holding, sitting tight for now. Everything's looking good. Back and forth. That, to speak to the QQQ trade speaks to the VIX trade. No reason to update that. If I'm wrong on this, we go up here, that VIX trade's not going to work out. If I'm right, we go down, we're going to hit my next upside targets on the VIX shorts that I gave you recently. Before I get off the indexes, let me, I haven't done it in the last couple of days an update, but let me just reiterate. Just as on the initial leg down from the top and the QQQ back in November of last year, swung that leg down, and I told you my two preferred indexes to short were the NASDAQ 100 via NQ futures or QQQ or any of those, and the small caps. I'm still looking that way now. You had this break of that's a year-long sideways trading range, and you broke it there. You had a back test there, which was highlighted as an objective shorting up. Got a big nice, double-digit pullback from there, and then once again we back tested it again. So just like the index is back testing the 200. In fact, that's what you did here on IWM. You also back tested the 200 simple day. Although with this consolidation that we've had for a year long there, you got choppy and you kind of traded through the 200s for a little bit there. But we did, it's worth noting that we had a perfect back test, or near perfect, of the 200-day exponential moving average there. And so far, rejections. Two things happened recently. You back tested the bottom of the range, you actually recovered it for just a day, got shot down hard, and impulsively the next day, that red candle took us back down and below, tried to regain it for a few days, and rejected again. So these are all, that and that, what I just covered on QQQ, at least for the last week or so, are check marks for the bearish case. And again, being just like the Qs backtesting that 200-day back here relative, to what IWM backtested that range, and then there and rejected, both of that looks the same. That's enough. Again, anything's possible. We could sit here like this and go in another range for months, and most importantly would be not to take out the top of that range by any wide margin or solid weekly close. And likewise, you want to see a break of the bottom of the range. But the ideal scenario at this point, again, would be that second test, not counting each individual day, I'm talking that cluster a week or so there, a week testing here. Ideally, that would be the last, and we go on to breakdown. But you don't always get what you want. We'll take it day by day. All right, the other trade ideas thrown out recently, been in and out of crude, long short, for a while there after the invasion. Kind of stayed away from it because it was just completely headline driven. Fundies are playing out now a little bit better. I'm sorry, technicals are playing out a little better now. There's a falling wedge. You have this positive divergence still intact, pointed out yesterday, still very much intact. There's your divergence line, there's your downtrend line, and you've got support here. You also had support just above there at about 96.27. That might have been where I covered it yesterday, but we had a little punch down. I'm not sure. I can't even remember now. It should have been, either way, we're still at a pretty decent support level. It was okay back here too. We had support at 98. We went through there, consolidated for a few days, but most importantly, bigger, not big picture, but intermediate term, is this wedge, this divergence that's been building for a while. And you can see now, it's holding this 93.64 support. So what you want to see if you're long crude is a break back above 98, a solid break. That doesn't mean a tick to 98.03, but a solid red candle there, follow-up red candle, and then boom, a break above this uptrend line, and that should trigger some more buying in crude. At this point, a stop probably below today's lows makes sense. Not too far, because anything much below that, you're going to take out these divergences with lower lows. And there's really my next support. There's some minor support, but I have a support line here from a while ago all the way down to about 89.50, and that's to me too far to ride down. So sticking with this one for now. Thinking there's some more upside to come in crude oil. And let's talk gold and silver. I updated them yesterday. There's not much to say on that. It continues. GC Gold Futures continues to hold this line. This is where it was a week or two ago. Give you a hard buy right here on gold at 18.95. And so far we're well above that level for now. So, but this has become a very, very well-defined trading range right in here. One little brief pop above, but other than that, that's contained all the trades. So this is like we say energy building like a coiled spring. Pop above 1960 should take us up, and a break below 1920 would most likely run us back down to at least where we entered, that 1895 support. and then anything below that, that's just no bueno for gold. But I still favor this for now. Just got to be patient on this one. Like anything, it's, you don't fall in love with it, but I like it for many reasons. Number one, it's diversification. It's a completely different asset class than equities or bonds, which I'll get to next. And then, of course, silver. Silver is going to ultimately follow its big brother gold. And this is what it looks like on the 60-minute chart of SI Silver Futures. Downtrend line that I'm not crazy about because we don't have that third distinct reaction, but close enough. So you had a downtrend line there, and you had divergence at this point right there on the PPO. You can see down below. And you have pretty good support here at about 24. That's where I gave you with gold, along with gold, a hard buy on it at 24. So again, that's I think stop should be not far under $24, and favor upside break. First resistance zone is right about there. That's about 25 and change, just over $25. And then you can see these other. But I think if it breaks out the next time around, if things go where I think they're going, remember, we were getting, well, when the markets were correcting, we were short equities and long gold and silver, and we were doing well because they were getting a flight to safety bid. That whole Bitcoin's the new gold thing that they were trying to, people were claiming for a while, finally realized when the proverbial shite hit the fan a few weeks back and the Nasdaq dropped 20% plus. That's when the whole gold thing was really tested. And guess what happened? Bitcoin was falling hard with the stock market as a speculative asset, and gold was going up. So I think we'll see the same thing if my weekly targets and my next downside targets are hit, and we get another wave of selling in the markets, whether it happens anytime soon or whether it's 6 months from now. That's when I think as long as the charts on gold remain constructive, that's when we'll probably get our next leg up. Until then, might just flounder around and be a dead money trade, so to speak. But again, it's profitable, but not by much. I mean, there's where we were a week ago or so when we bought it. We're a little bit above that now. The other one I wanted to update is Treasuries. As I mentioned yesterday, I think the sweet spot for trading right now is a short end of the yield curve. And I'm talking the 5 years where I'm looking, not the super short. I'm not trading the 2 year. I like the 5 year, and that was ZF, the futures. And you have this nice bullish falling wedge. Remember, I showed you the 5 year Treasury yield is at a very, very significant long-term downtrend line, and it got very overbought to get there. Yields and bond prices are inverse. We trade the bond prices. You don't trade yield. At least I don't trade the bond prices. So this is it. It's it either works or it doesn't work, but it's a nice, clean, bullish falling wedge, and a little bit of minor resistance right there, but that comes in line with the wedge. So if you pop the wedge, boom. These are my targets: 114.262, 115.313, 117.021. Actual resistance levels, meaning unadjusted targets. Therefore, you want to sell if your preference is to, let's say, target that second target. You want to have your sell limit order just shy of 115.313. Or what I like to do is, if you get close to it, you ratchet your stop up and you let it run. Sometimes you can blast on through a target and head on to the next one, or you have a little consolidation and then you go. Many ways to trade. And then again, for those of you that don't trade futures, and I know that's a good percentage, that's fine. IEF is the ETN that trades targets the 5 year Treasury bond. You got the nice same thing, 60-minute falling wedge. It's not as clear here. The reason is bond futures, like stock index futures, will trade virtually around the clock. So you have a lot more trades, therefore a lot more reactions. This is 9 to 5 trading right here, 9:30 to 4 p.m. technically, regular session trades. So you're not seeing. That's why I'm using the futures charts. And also the leverage. I mean, this thing, even if my final target up there is hit, it's going to be a whopping, 3.3% return. Trading NQ or QQQ lately, you're making that in a day, a single day trade. That's been the range back and forth because Treasury bonds move less. So you got to take a lot more in IEF to make it worth your while, or pass if it's not your cup of tea. Alrighty, what else? Oh, yeah, I wanted to do an update and tell you. I'll just not go over each chart of the pot stocks. I threw those out there recently, and I think most are, yeah, they all are above where we are. They were first highlighted, but as I said, they were a play. I shared those because it was a game of musical chairs a couple weeks ago. For the last few weeks, I should say, last month or so, the music's been playing. The stock market bottom, those bullish falling wedges that were highlighted on the indexes, the 60-minute charts, the SPY and QQQ played out. They broke out, number one, and then played out. And because of that, the Reddit crowd, or what do you call it, Robinhood traders, came back into the market just as they were doing last year, and they started buying the crap stocks. They started buying. This is the ETF that's the pretty much the epitome of them all because it contains them. Meme, as the name so fits, and that's it. Broke out, but then nothing but being faded so far. So what I was getting at here, or what I am getting at, is the music's over. It is a back test, and maybe they'll come in. I showed you that yesterday on GameStop and AMC, which I'll get to right now. These are the poster childs of meme stocks, and I told you yesterday, and it still is. It pulled back. It had a big run up after the divergent low. It's at 143, but for the time being, the momentum is it's over. That strong upside. This could be a flag. We could have another leg up. If this happens, I can tell you right now, it's probably going to happen with the market going on to challenge or break out of the previous all-time highs. In other words, we take back the 200-day moving averages, everything I started the video with. We take back the bottom of those big topping patterns on QQQ and SPY on the daily charts. And if that happens, then yeah, you're going to have a risk-on market, and there's a much greater chance that these speculative trades, these meme stocks, will take off. And then if that's the case, spot stocks will probably take off. So that's GameStop, GME. There's AMC, pulled back and still hovering around that $20 support. And same thing, if the party's over and the stock market's going to take another leg down, that's probably it. That bear market rally is probably over, and it is. Make no mistake about it. It's a bear market rally. This is the high right here. This is a bear trend right here. From the peak back here, AMC to the low, fell 82%, and it's still well below. It's pretty much challenging these previous reactor challenged and then got knocked down. It also got knocked down off. You got it right there off that 200-day moving average, just like the market just got knocked down off of. And so that's a signature of a bear market. Bullish when you're above the 200s, bearish when you're below them, and they act as resistance. So as long as I'm seeing the stock indexes and a lot of stocks, even market leaders, below the 200-day moving average, Facebook, former market leaders, that is, Microsoft tried to regain it right there, boom, down below, Amazon and the like. So that tells me right now, put a preference, take a bias. Truly can't stand the people, just trade the charts, don't have a bias. You got to, it's paralysis by analysis. You're never going to make a trade, because I can make at any given point in time. You want to say, Randy, like the old debate team in high school or college, your job is to present a bullish case on the market. I could sit here all day long right now and present a golden, great bullish case to buy. I could use fundamentals, technicals, but I also could make a good bearish case. And the thing is, you got to take one side or the other. When you're not sure, when I analyze the charts and I can make both a bullish and bearish case, and I really, it's a coin toss of which one, I stand aside. That's the thing. And just one takeaway is, I've learned this over the years, you don't always have to be in the market or trading any particular security or trading at all. If you are unsure, there's nothing wrong with sitting back. But right now, again, based mainly on many factors, things I talked on for months now, breadth divergences, market, breadth deterioration, long-term trend lines and support levels and key moving average and trend indicators and all that evidence taken together points to the fact that this is quite possibly, or quite likely, I should say, quite likely early stage bear market action. You go to the weekly charts, and when I lose my faith, quote, so to speak, from a big rally or something, I just go back to the long-term charts, and I look at that. And these are the weekly charts on Amazon. I look at, for example, this most recent divergent high. Last time we had a divergent high, stock fell 36%. Time before that, 14%. Same thing. Apple's the leader, the market leader, and and also held up AAPL. There we go. And it's held up so far. And when this guy breaks, the market breaks. It's almost single-handedly saved the day with a lot of other stocks dropping below their 200 days. But Apple still holding the 200 days. And this is a weekly chart, the 40-week simple moving average. And the exponential, they're right together. The red line, the blue line. Look at that. Perfect test. Several weeks. Boom, boom, boom. And a weekly chart. All that matters is how you close a week. Tested it there successfully. Tested it here on several weeks, about 4 or 5 consecutive candles. There. Even there, even when COVID hit, one single week below, the next week would close right back on it, or right on those lines, and then recovered them. But the last time we were below those was right here in 2018, that big Q4 drop. And once you took it out, there was another from that point. Oops, didn't mean to move my downtrend line, just trying to measure for you. There was still, out of that 39% drop from the high to low, there was still another 25% to go. And once again, very important, that was just a bull market correction. 39%, yeah, some will call it a bear market. When you look at this, here's what I see. I see a cyclical or a secular bull market with, if you want to even call them cyclical bear markets, you can, but they're really corrections. And all they do each time, and the ones that are big are the ones that take out the 200 days, like right there. You took out the 200 days and you dropped the total drop from the high, which came right before that, was 45%. The rest were corrections back to the 200 days. The buyer stepped in. So that's what I'm watching. This is a big one. I'll be watching Apple. I watch it every day. And then ultimately, I think we're going to have a mean revision. Every now and then you have the most powerful of stocks will come and visit a long-term trend line, like it did there, like it did there, like it did there. And this time around, the bigger you get away from the mean or the average or the trend, unfortunately, the more powerful the mean reversion is. So Apple, for all is said and done, and I think there's a decent chance it'll be in the year 2022 this year. We'll see. That's a pretty aggressive call. I don't think so, because stocks tend to fall a lot faster than they rise, as you can see anytime you go back in the charts. But you're talking a drop of Apple of depending on when we get there, about 59. Well, that's depending again where you get there. Let's just call it north of 50%. But for that to happen, it's got to break. And I've been talking about that divergent high for a while. We got a divergent high there, 21%. The divergence has only gotten bigger, which also indicates more likely a bigger correction coming. But you got to take out these 40-week moving averages, 200 days. You got to take out this trend line, this price channel we're in, and then you don't want to be long equities when that happens. So to kind of summarize it, back here, what was it, about a month or two ago, was issuing what I use the analogy of hurricanes and tornadoes, and the difference between a hurricane or tornado watch and a warning. And again, a warning is much more severe. Says those conditions are likely. You're likely to see an imminent and much stronger odds of it happening and happening soon, of you being hit in that area where there's a hurricane or tornado warning, versus a watch. We're back on a watch. We were in a warning here because we took out the recent lows and could have had a lot more downside, but we didn't. Those 60-minute bullish falling wedges, which are right here on this weekly, same thing right here, played out. The divergences, they were being watched, and then boom, there was our breakout, and they played out. And again, they played out for almost the measured target of the wedge. So right now, I can't really issue a crash warning unless we start to get near there, but we're certainly on a watch. But right now, market conditions have stabilized a lot more. We're well off those lows, and volatility has abated quite a bit. Although, again, it's starting to pick up recently because we're going down. The volatility tends to expand when you're correcting. It contracts, when you're going up for the most part. So. And that's it. So in summary, at this point in time, looking out, let's just say for the next few weeks, if you want to use that time frame, the near to intermediate term, bearish equities, cautiously bullish, but bullish crude as long as it can hold up. bullish silver and gold, although they're not, they were hard buys at that level, but right now they're in consolidation mode. I give you levels that, if popped, could trigger the next upside. So what was that? Treasury bonds bullish. With obviously with being bearish equity markets is also to be bullish the VIX. And then right now, for the time being, I've cooled off, and I wouldn't be adding back to those meme stocks until unless I get some, or not memes. I'm sorry, I never really threw those out as trade ideas. I just showed you levels if you want to buy them. I'm talking about the pot stocks. They are pulling back to support. We're back to T1 on OGI, the first target. This is where they were first mentioned. So like I said, we're still, from the initial video where they were throwing out as trade ideas, they're still very much profitable. They've just given back a good chunk of the gains because that dash for trash has seemed to take a turn, and it's certainly come down. You can see they're tracking meme and AMC and Gamestop very much. So that's that. Let's wrap it up here. And if I see anything else new, I'll get it out to you. I did throw out a bunch of trade ideas the other day. Before that was yesterday, individual stocks, and then a few sectors that also stood out to me earlier this week. So we'll wrap it up here. And if anything big happens before the close, I'll get another one out to you. Otherwise, there's not much to add, even from the update I gave you this morning. Let's see which way QQQ wants to break. If it wants to make another run down, I'd love to see that today to close back below that 351.68 level. We've already moved through it a few times, so really now the bigger level is today's low. And again, if we have another run at 357.15, they've already gotten rejected a few times. It's going to increase the odds of a gap backfill, especially if we enter the gap. And that's really ideally where any advance this week should be capped. All the better if we can move lower without even backfilling the gap. But like I said, coin toss odds, I don't know right now. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.